and everything. I do want to kind of keep questions to a minimum until the end, but unless you've got something that's like super on topic, like right that we're talking about right then and there, by all means, go ahead and drop it. Unmute yourself real quick and ask it. But other than that, if it can wait until the end, we'll do a whole round of questions at the end, and we'll get all that. But other than that, shouldn't take too long. Kalua, you're all good recording, right?
Pick out your notepad and pen, boys. It's a good one.
Yeah.
Oh yeah, you definitely might want to take some notes if you'd like. All right. So the first thing about we got to kind of go over some of the benefits and negatives of owning a long-term portfolio, right? So some of the weaknesses of having a long-term portfolio, right? You have to be able to kind of, be able to hold. You got to be able to close your eyes and deal with some downside, right? You got to be able to average in, right? And you have to have faith in a company, right? So those are some of the weaknesses of holding a long-term portfolio. And it's also kind of, you're giving up that capital for future gain, right? And so that capital, it needs to be capital that you're okay setting aside and not touching, right? You need to be able to live without it, okay? And so, first things first, right? You shouldn't be starting a long-term portfolio if you've got your eyes up to your head in bills, right? You should put your money where it needs to go immediately. But if you have extra income to put in shares, that's what it should be, right? It should be disposable income that you can set aside. I think that regardless, a lot of companies, if anything, that set up 401ks for you, that's where you're getting that input, right? So they're setting it aside for you. But otherwise, there are plenty, if not way more benefits to owning a long-term portfolio than negatives, right? Really, the only negative I can imagine is if some company that you pick doesn't stand the test of time, maybe ends up slouching, and you need to cut it for a loss later on. But realistically, I believe that there's no real reason to cut any long-term so long as you believe in the company for the long-term, right? If you have faith and conviction in a certain stock based on their fundamentals, you should be just fine holding, right? And we've seen that over any 5-year period at all, any 5-year stretch, the S&P 500 is green, right? And me and Jazz were just talking about this earlier. The percentage of people that are down holding shares within a year is about, 40%. You go 2 years, that number gets cut in half. You go to 3 years and higher, it just gets smaller and smaller until you get to about 20 years. Over 20 years, holding anything in the S&P 500, there's almost a 0% of people that are down on their initial investments, right? Time in the market over timing the market, always, right? Some other advantages, you've got dividends, right? You're able to average down, you're able to get better entries, right? You're able to really become familiar with the stock, you get to know it, right? And so those are all just sort of advantages and disadvantages, just kind of intro to owning long-term stocks, right? So then I kind of want to get into account types, right? Personally, for me, I prefer to have individual cash accounts. And the only difference being that there's no benefits for me to hold long-term. No matter when I sell, I will be subject to the capital gains taxes based on the state, based on wherever I happen to be, or whatever legislation is going on at the time. I'm subject to those capital gains taxes because personally, my growth accounts and my long-term portfolios, I plan to use that capital, right, in the future for, let's say, franchising or a home or something like that. I plan to use that capital. And so I want to be able to just pay the capital gains taxes compared to being fined for using my money that I have in an IRA or a Roth. Now, there are still advantages to having an IRA or a Roth, right? You can still control your own positions. You can still buy and sell stuff within the account without penalty. But as soon as you withdraw something, right, and it's not past your date, so when you create a Roth or an IRA, you essentially sign off on a date in which you cannot touch the money until, and when that happens, you don't face any taxes. It's untaxed income. And so you can basically just hold long term, and eventually when you want to retire, take that cash out and be totally good. And so depending on what your goal of the account is, it may vary what type of account you want to use, right? Like I said, I I plan on using the capital for other types of investments or purchases in my life. And so I don't plan on, holding everything until I retire, right? And so there's no reason for me specifically to have an IRA or a Roth. But if you want to just build a passive growth account that will serve as a retirement account, you can start a real IRA, sign off on whatever age you'd like, and completely be tax-free at that time. However, like I said, there are penalties for withdrawing that cash before your time has come, right? So not only will you have to pay capital gains taxes, but there are also fines for taking the money out. And so you have to pay in some cases, it can be as high as like 5 to 10% of the withdrawal amount to the broker, right? And so that's nobody wants to deal with that. And that's typically only happens if people have, emergencies or, they have to make some quick purchase. That's the only time people have, to deal with these fines. But most of the time, if you're starting an IRA, the plan is for retirement, right? IRA stands for an individual retirement account, right? So Roths and IRAs are great. I personally chose the individual cash route only because of my goal for the accounts, right? So getting into the goal of accounts, when you start to build a portfolio, right, we've already established that the cash is negligible. You are aware that you are putting that money aside, right? You don't need it. And then we've also are aware of what type of account we'd like, whether it's an IRA or a individual cash account. We decide the goal of the account, right? And so this is where it gets more personalized. Okay, you're talking about, are you going to target growth stocks? Are you looking for, innovative technologies such as, telehealth or electric vehicles or solar power, right? That would be a growth-based portfolio. You could target dividends, and me and Breadman and Jazz all have one of these portfolios. They're called DRIP account, and what DRIP stands for is dividend reinvestment. And so let's say you hold 100 shares of Coke and you get that 40-cent dividend, make $40 off the shares, and it automatically buys more equity of Coca-Cola, right? So that's a dividend account and essentially a self-funding portfolio, right? You don't really need to add to it. You can if you'd like, but the DRIP is supposed to fund the account and grow itself, right? And so that's what's called a DRIP account, and that is a goal of an account. You can have it sector-based. You can go, okay, I want to target, electric. So you'll have some EVs, some new EVs in there, some growth stocks like some NEO, some Plug, and then you'll have some blue chips as well. Maybe PG&E. You'll have maybe some Chevron, Exxon Mobil, because they will be stepping into energy. Trust me, right? And maybe some Tesla, right? So you'd have a weighted but sector-based portfolio, right? And these are all just different goals of an account. And that's very important. That leads into our next section of what to actually pick in the portfolio, right? And so once you picked your goal, right, once you have the cash that you're ready to set aside, you've got the goal of your account, you know what you're targeting, you're going to list a whole list, an entire list. It may take you a couple hours, it may take you a couple days. You want to list every single stock that you ever want to accumulate in that portfolio, regardless of the amount of money that you have in the portfolio, right? One of the big things I like to say is don't settle for NEO if you want Tesla, right? And that goes for everything, right? Don't get, how do I put it? I can't think of another example right off the top of my head, but the only case in which this wouldn't apply to is things such as direct competitors. Like I would think you could probably be able to substitute Walmart for Target. You could probably substitute Microsoft for Apple, right? Like those are direct competitors and they're equal weight, I would say, right? So that's a situation in which you could settle for one. I still wouldn't suggest it. If you want one or the other, go with the other. But don't go for cheap just because it's cheaper, right? Get the stocks you want because you believe in them, and it's okay. It's okay if you use a larger percentage of your portfolio. It is a growth account. You plan on adding to it. And so going into that list, what you're going to do after you've got your entire list, right? It may, like I said, it may take you 2 hours to write the whole list. It may take you a handful of days. You'll probably continue to add to the list over time as you discover new names within whatever goal you're targeting, whether it's dividends, sector-based, anything, right? You will find probably more names that pop up. But once that happens, right, you're going to assess all of them. Go through, perform your own technical analysis on each individual name. And you're going to go through and you're going to go, okay, what's the best possible buy spot, right? Obviously, the best is the cheapest, but the best possible buy spot in which you could get an entry that, it's long-term. So you want to buy on dips, of course. You want to catch the lows. So, of course, any company that you're buying, you obviously have the premonition that you expect it to stand the test of time. And so buying on a dip should be no problem if you plan on holding long terms. You should be able to look at these down days like today and go, okay, what's on discount? What looks good, right? And so you're going to assess every single name in the chart. This is going to take even longer than it took to accumulate the list, I'm sure. This will probably take a couple weeks, but you're going to go through, pick every single chart. Where's the best entry? Where can I get in? Set your alerts, and as those numbers start to get hit, buy those shares, right? And like I said, let's say you're only starting out with $1,000 or $2,000. Clearly, if you want Amazon in your portfolio, you're going to need a little bit more cash, and I wouldn't suggest buying just one share with your entire portfolio. If you're still dealing with smaller accounts, still focus on maybe the cheaper within your list. Like I said, you're not going cheaper just because it's cheaper, but you're going cheaper within your relative list, right? And so you want to get those shares start to accumulate. And if you have only $2,000, let's say Tesla happens to be the first dip, it's okay to get a share, and it's okay to spend, maybe 20-30% on one position at this time. It's totally fine. Just work on getting the shares that you want. That's it. The biggest thing that comes with this too, even if you're working with a bigger account, this is going to apply to you more, but make sure you're getting the names that you want, but also don't go all in, right? If you plan to own, let's say you're divvying everything purely based on percentage of your account, right? Like, so if you're using a $10,000 account, you only want to spend $250 per position in your portfolio, right? So let's say Coca-Cola, it's about $50 a share right now. You have enough for about 5 shares, right? So if it comes down into your dip area, you're not buying 5 shares. You're buying 2, maybe 3. You give it some time. Let's see if it bounces where you want it to. If it does, great, you can add into it later, right? If it doesn't, you still have the capital allocated to be able to buy it, right? If it dips lower. And it's still well within your buying power for which you gave to that position, right? So you never, ever go full position in at once, especially at long terms, right? You can always get a better entry. There is a very, very low probability that you are going to catch the lowest low that a chart will ever make again. It's just very low probability. So yes, it is a long-term game, but the goal is to get a good entry and then average into it. And along the road, I've added to positions that I'm green on because I want more of the company and I still believe in them for long term. And so averaging into a position that's green is totally fine. Obviously, I wouldn't be buying the highs. You still want to catch relative dips, but I have some positions that are up 300% that I added to when they were up 100%, and I'm still so happy that I did it. And the biggest thing is just conviction, right? If you're buying into a dip, you have to have conviction, right? Everyone knows that no one likes to buy into a dip and have it keep dipping. So that's another big reason for having that, never go full position at once. It's just not worth it, right? Because you're going to feel like an idiot when you buy Tesla at 700 and the next day it's at 640 or whatever, and you don't have enough to get more, right? When it's going to be right back over that in a couple of days. So that's one big thing to worry about. It's not a big thing to worry about. I didn't mean that. It's just something to keep focus on. But that leads us right into our next thing. Adding into an account by means of a separate income, right? And so if you're doing that drip account, that's pretty much the only self-funding account that you can really do, right? Most of the time, you're going to have to put money in because just like we talked about, if you're starting with $2,000 and you occupy all that capital to buying shares, you can't buy anything else unless you sell equity, right, to get capital. And so you need to be adding into the account, right? And so however you do that is up to you. Personally, you guys know my strategy. I personally, real quick, I have a trading account. I have a growth account, which is my main long-term. It's the biggest. It's got the most names in it. The goal is pretty much just long-terms. It's just everything I believe in long-term. It's got every sector in it, everything you can think of. And then I've got a drip account myself. And I've got what I call a challenge account, which is I kind of trade shares in it, but I only use equity. And so it's a little bit of a challenge account. I'll hold shares for maybe like 2-3 weeks at a time, catch a move, and be done with it. And that's called the challenge account. But my trading account has a set amount that I'm very comfortable with. And so 15,000 on Friday, if I'm green, let's say I'm up to 17,000, we take that $2,000 out and we split it between the two long-term accounts, the drip, and we split it between the long-term, right? The challenge account is a challenge account for a reason. We don't add money to it. That's why it's a challenge account. But the drip account and the long-term account, that's my means of adding to my long-terms. And so no matter what, every single day, even if I am using a large percentage of my total buying power holding equity, I always have capital to be able to buy more of whatever I need to buy, right? That's the biggest thing. You never, ever, ever want to be 100% exercised in your positions, right? If you have a $3,000 account, it's a little bit different. If you have a $30,000 account, you should very, very, very much have, an extra, $3,000 or $4,000 in the account ready to be able to deploy if needed, right? And not only that, but who wants to be in a crash, in a market reversal, when your entire account's exercised in equity? That doesn't feel good, right? And just knowing you could be getting dips right now, you could be adding to some of these positions that may be going red, right? So you have to have some way to add to the portfolio. Personally, I use trading. I know some people's jobs offer allocations into their 401ks. That is awesome. But I personally recommend the trading route, because if you can trade options successfully, you're probably doing great on your own. But with options, let's say you get your account to, I want to do a full example, and this is what someone in the group is doing now, that is, as long as you stick to your rules, it works very well. What you want to do is set aside that X amount of capital that you want to start buying shares with. Go ahead, go through your list, get your dips, exercise the account. Once you have your trading account at a comfortable amount, right, this is what you're going to do. Let's say you have $5,000. You're comfortable trading with $5,000, right? Same thing on Friday. I think every month is too long. It gives you too much time in between payouts, so that it kind of distorts. If you grow your account too much, it distorts your value. And if if you go too long, maybe you throw away some of the gains before you can withdraw them. So I think a month is too long to do, and I think every day is too often, because it's just you're just making withdrawals every day, and you have a bunch of unsettled cash all the time. But every week is just fine. Gives you a whole week to reset. You basically get paid every week so long as you stay green. And soon enough, even if it's just $10 or if it's $10,000, withdraw the extra cash, whatever amount back to whatever amount you are very comfortable trading with, and then put that into the long-term account. That way you have extra capital to be able to buy those shares, right? And soon enough, your long-term account's going to become bigger than your trading account. And when that happens, now I can scale my trading account up, right? You go from 5,000, work it up for a week or two, maybe 3-4 weeks, get it up to 7,500. And now every Friday you're over 7,500, you add into the long-term account, right? So that's going to make you super comfortable with your trading portfolio, and it's going to build you a pillow, right? It's going to build that pillow of support. Most people use their long-term accounts as exactly that, long-term accounts. But let's say you happen to blow your trading account, you've got a pillow, you've got something you can come back with, right? And I wouldn't suggest ever liquidating a long-term account to trade with, but if that's what some people want to do, it's completely up to them. I personally know that a lot of people who just have a trading account are very tedious with it. Like they're not as comfortable with risk. Whereas if you have kind of a pillow, I'm not saying go out of your risk management or go out of your comfort zone, but it does loosen up a little bit and realize, okay, it's not the worst thing in the world if I maybe have a down, 4 or 5% day, Whereas if you just have a trading account, a lot of people get really stressed on down days. So building that long-term account is super important. But yeah, have some way to keep track of what you put in, right? I use an Excel sheet that keeps track of every time I make an input. It keeps a little total at the bottom. Every time I add cash to it, it tells me the total, how much of cash I've put in. And then it also tells me the total amount of the portfolio minus what I've put in. And that's my total profit that I've made from the input, right? And so you got to have a way to keep track of this. And it's as simple as just an Excel sheet. I'm more than happy to leave or link an Excel sheet that's fully templated and it's totally good to go. But you got to have some way to keep track of what you input, because if you lose track of how much you've input, you have no clue how much you've really made. And at that point, what's the point of it even, right? You're not keeping track of your progress. Your brokerage will have that information somewhere, whether on their website or even on their platform somewhere. But I like to keep that information personal and not to myself, but I like to have that information. It helps you grow as a trader, and knowing your history helps very much.
Can I hop in for just 1 second as well? It's a little sidebar off topic, but it's stemming off the keeping track of things in Excel spreadsheets.
Yeah, go ahead.
If you're not trading if you're not tracking your options trades as well, I highly recommend doing it. I started it, and I can literally notice trends in my trading. I see when I'm doing something I shouldn't be doing. Just little things, So not only tracking a long-term account, but also tracking your trading account. And you should be meticulous about it. We have a spreadsheet I think it's in Helpful Links or General Knowledge, one of the two. It's already made for you. All you have to do is type numbers into it. It's really easy, and it helps a lot. Sorry, go ahead, Wax.
Going on for that same topic, once you start building, I would suggest keeping track of your trades, even your trading, off topic as well. Just talking about your trading and your long-term account. When you keep track of it, for my long-term accounts, I only keep track of it by week, how much it changes by the week and how much I put in. But on my trading account, for that spreadsheet, it's got how much I made or lost for the day, total commissions, PL for the week, PL for the month, everything. And when you keep that detailed of records, it's not even that detailed. It's just the numbers are right there on your TOS or on your Tastyworks. You just got to input them in the Excel. When you do that for long enough, I've been doing it for about 1.5 years now, I can go back and I can see, okay, what months did I do really well on? What months did I, kind of fall behind? Where was I most consistent? What was my best day ever? What was my worst day ever? You're going to build a track record for yourself that not only you can refer back to and kind of look at stuff, but you can also learn from it yourself, just as Joe was saying. And so it's kind of going to...
If you want to send that to Wax and kind of get some feedback on it, I guarantee you he'd do it as well. But you have to track your trades to be able to send it to anybody.
Yeah. Yeah. And when you track your trades as well, there's no negative that comes from it. There's really none. And so that's going to kind of lead us right into our last little bit. The biggest thing. What's up?
Yeah, a quick question. So you were saying how you want us to maybe use this strategy of paying ourselves end of the week and then putting it in a long-term account. Would it have any implications from the tax side?
Well, the capital gains that you make from the options are already going to be taxed. What you do with that cash doesn't really matter. In fact, if you put it back in longs, as long as you hold them for over 1 year, they're taxed at a lesser rate.
Okay. Got it.
So, in fact, actually holding that capital may be better. And, hanging on to your gains anyways, instead of spending it, you're going to be surprised by the time, you get to taxes and you have all this extra cash. Most people that I know that live off of trading, come tax time, they usually have to make a withdrawal, or they have to, deplete their accounts to be able to pay taxes because they're living off of trading, where it's like, that's not the goal. That goal is only real if you have a large enough account to sustain it.
Right.
To make like an average salary of, say, like, I don't know, $40,000 to $60,000 a year, you got to have a dividend account of probably close to $1 million, and that's a drip account, right? And that's paying 5-6% a year. And so if you want to live off of just passive income trading, you're going to have a very sizable account to do that with drip. But it's very possible. And if you think about it in the grand scheme of things, I promise you $1 million is, I don't want to belittle any amount of money, but $1 million is a very achievable goal with trading. It very much is. And if you're, and I just want to say to everyone right now, everyone thinking about a long-term portfolio right now, you guys are so ahead of the game. It's just, it's crazy how young everyone is in here, and you guys are already focused on building long-term portfolios. You guys are going to be so far ahead of so many people by the time you guys are just 35. I know we got some people who are older than that in here, but trust me, all you young guys getting into this now, it'll help so much. And if you can really get into a habit of adding to that account, trust me, dude, if you guys, even if you guys have a minimum wage job and you get paid, $400 or $500 a week, use $100 a week, throw it into that account. Telling you, it will stack up so much faster than you think. And the great thing about long-term shares is they act like compound interest, baby. The more you put into the money, the better the gains will return, and the dividends to keep adding. It's exponential growth, right? And it starts slow, but that's why you've got to start. Okay, so
yeah. Stock talk that kind of explains starting sooner than later.
Yeah.
If you guys want to.
So I think I covered everything I wanted to.
Yeah, Rex, if I could jump in.
Yeah, I'm gonna hand it on over to Jazz. He's gonna touch on a few more topics, and then right after that, we're gonna wrap it up with some questions.
Yeah, so I was just gonna sidebar off of Amar's question about the taxes. Like, that's the big concept with your money in the market. There's a difference between realized and unrealized gains with the way the IRS looks at that. So when you sell something, as Wax was saying, when you're going to withdraw that, if you want to put that in a long-term account, you want to put it in a checking account and spend it, you want to just leave it sit in your trading account, it doesn't matter. As soon as you sell it, that's when it becomes a taxable transaction. That's called a realized gain. So when you have unrealized gains are, I can pull up my long-term portfolio right now and show you that I'm plus 200% on these shares that I'm holding. But I didn't actually make 200% on those shares because I still have them. They're just worth 200% more than what I purchased them for. That's an unrealized capital gain. It's not taxable because I haven't actually made a transaction to sell that yet. Once I sell that for plus 200%, now I have realized that gain. And now that's when that becomes a capital gain. And if you've had that for less than 1 year, you can be taxed at the short-term capital gains rate. And as Wax said, you're just going to have to pay taxes on that because you sold that, but you can allocate that over into your long terms and you'll be taxed at a lower rate if you hold something for longer than a year and sell it in the future.
So let's make an example. Let's say you buy 10 shares of X stock at $10 a share, right? So it's $100. Now you make 100% on that and you turn it into $200. You sell all of those shares. And so that is $100 in realized gains. Now, depending on what state you are, it may vary on how much you have to pay on that. Let's say it's just a basic 20%, right? You cut off that $80. You take that whole 100, right? You're going to be taxed 20 out of that 100. You throw it in B stock, right? And B stock makes you another 50%. Boom. Now that $100 is $150, but so long as you don't sell it, you still only owe the $20 in taxes from the first transaction. Right? And so that's a situation in which, using that capital to redistribute or to redeploy back into the market was very much worth it. Okay? And so you'll still have that same tax, but so long as you're holding those shares come tax time, you'll still only be taxed at $20. Right? So that's a big thing. I think we are good to go for questions now.
Yeah, absolutely. I was just going to make one more general point, and then we can do questions. Like the the last thing I was going to say was about one of the first things Wax touched on was in that it kind of comes back to the whole like time in the market, over timing the market. And that's, there's different ways you can use your money in the financial markets. There's leverage derivatives and binary options. There's shares of companies. You can play equity, and you have to have different goals. And kind of incorporating the point where Wax said, don't buy NEO if you want Tesla. Don't just go for cheaper. You have to have long-term growth goals, and that capital that you use long-term in the markets is tied up. You can't trade that. You can't buy fixed income securities. You can't buy commodities with it because it's tied up, holding that asset in the market. So you have to be able to kind of at a fundamental level invest in companies that you have the conviction to believe in them, that over the test of time they'll perform in a way that will return your capital at a higher rate than if you would have used that capital in different ways for that 10-year period that you left that capital in that company. So it's very important to find high value companies that will perform well, stand the test of time, that you truly believe in, that can actually return you, high rates at a lot. And that's why, we trade all sorts of companies all the time that we might not even really be a fan of, but that doesn't mean there's not an opportunity to make money off of that. But when you're going to invest in something for 5 to 10 years, there has to be a fundamental backing and a real world business level reason why a business will become successful and truly stand the test of time. And that's all I have on that point.
I think we're all good then. I just want to say though, you guys, if you want to implement any of what we've talked about, if you need help writing your list, if you want help picking out a goal, if you don't know what account is right for you, or you want to know how much to allocate, let me know. I'm more than happy to help you guys with this. I think devoting money to a long-term portfolio is one of the smartest things you can do. In fact, I love Glego to death, but I hate that he is one of the people that just builds up one giant trading account. And so when he takes losses, they're big losses, right? Because his risk management grows with his account. And so, he has set some cash aside, but he overall just trades with a very large trading account. That's not me. I like to make my money, put it away, and then keep making money with the amount that I'm comfortable with. So, trading is very different for everyone, and you may find that your risk aversion for shares is much higher than options, and you may find that you're a share trader at heart. So I very much encourage you guys to get into it, ask questions, let me know if you need any help. I'm more than happy to. But yeah, let's move on into some questions. If you guys have any, let me know. What do we got?
I have a question. Have you guys recorded the first part? Because I missed it due to a meeting.
Yep, everything's recorded, my man.
Thank you.
All right. Anyone else? No one got anything? All right. Well, if that's all, I hope everyone got some benefit from it. For the recording, this is BullPrint. You can find us probably with the link in the bio. You guys have a great rest of the day. I'll see you guys all tomorrow.
Yeah, if you guys have questions at any time, like at any period, I'm one of the biggest fundamental guys you'll ever meet, and me and Wax are around at any time you guys need. We love to answer questions, help you out. We have the same goals you do with long term. So we just want to grow as a community here. So.
All right, you guys have a great rest of the day.
All right.